Cryptocurrency has become mainstream, and with that prominence comes scrutiny from tax authorities worldwide. As the rules around digital assets tighten, investors must adapt by understanding how to manage their crypto assets in a tax-efficient way. This video delves into essential tax strategies for crypto investors, offering insights that are particularly relevant for 2025 as governments continue to enforce more rigorous compliance and reporting measures. Mastering the current crypto tax landscape. What's changed in 2025? The crypto tax landscape has undergone significant changes by 2025, with increased reporting requirements, particularly led by the Internal Revenue Service. The introduction of Form 1099-DA, effective in 2026, mandates that U.S. brokers and exchanges report digital asset sales directly to the Internal Revenue Service, increasing transparency and aiming to reduce tax evasion. Other nations, including those in the European Union, are adopting similar measures. Italy, for example, has proposed raising its capital gains tax on cryptocurrency from 26% to 42%, highlighting the global trend towards stricter crypto taxation. These regulatory shifts mean investors must stay informed and compliant, as non-compliance can lead to penalties. Staying updated on these changes is crucial for accurate tax reporting and avoiding legal issues. Understanding capital gains tax on crypto. Short-term versus long-term gains. The IRS treats cryptocurrency as property, subjecting gains or losses on crypto transactions to capital gains tax, depending on how long the asset is held. If an investor sells a cryptocurrency held for 1 year or less, it's classified as a short-term capital gain and taxed at ordinary income rates, 10% to 37%, depending on income. In contrast, holding an asset for more than a year qualifies it for lower long-term capital gains rates of 0%, 15%, or 20%. The potential savings from long-term rates encourage investors to consider their holding periods, especially with high-value assets, as extending ownership can significantly reduce tax liability and enhance after-tax returns. Navigating new reporting requirements. The introduction of Form 1099-DA. With the introduction of Form 1099-DA, the Internal Revenue Service is taking significant steps to standardize and monitor crypto transaction reporting. Beginning in 2026, brokers and exchanges will be required to report digital asset transactions through this form, providing the Internal Revenue Service with crucial details about each sale and exchange. For investors, this form simplifies certain aspects of reporting by compiling transaction data, but also increases the need for accurate record-keeping. Form 1099-DA works similarly to the reporting forms used for traditional stock trading, indicating the date and amount of each crypto transaction. Because the Internal Revenue Service will receive this information directly from exchanges, any discrepancies in an investor's reported transactions may lead to audits or penalties. This transparency push means that crypto investors must ensure their records match those submitted by exchanges. For those involved in frequent trading, this form is a reminder to keep detailed records to avoid issues during tax season, underscoring the importance of diligence and compliance. Tax implications of staking and mining. Reporting crypto income accurately. Staking and mining activities come with specific tax obligations, as the Internal Revenue Service treats rewards from these activities as taxable income. Investors must report the fair market value of rewards, like Ethereum from staking, as income at the time they are received. For example, if a staking reward is valued at $500 upon receipt, it must be reported as $500 in ordinary income for that year. Additionally, if these assets are later sold at a higher value, the increase is subject to capital gains tax. Accurate tracking of rewards and value changes is essential to avoid penalties. Using crypto tax software can help investors streamline reporting and accurately calculate income and gains from staking and mining. Leveraging tax loss harvesting to offset gains. Tax loss harvesting allows crypto investors to reduce taxable income by selling underperforming assets to offset gains from profitable ones. For example, if an investor gains $10,000 from one asset but loses $5,000 on another, they can offset gains with losses, resulting in a net taxable gain of $5,000. Currently, the Internal Revenue Service does not apply the wash sale rule to crypto, so investors can sell a crypto asset at a loss and repurchase it immediately to maintain their position while claiming a tax benefit. However, the wash sale rule may extend to crypto in the future. Working with a tax professional can help investors time these transactions strategically to maximize tax savings. Record-keeping essentials, a key to seamless compliance. Keeping accurate and comprehensive records is the cornerstone of crypto tax compliance, especially with the increased scrutiny from the Internal Revenue Service and the implementation of new reporting forms, like Form 1099-DA. Each transaction must be documented, capturing purchase dates, acquisition costs, sales prices, and transaction types. For investors involved in frequent trading or complex activities like decentralized finance and staking, managing these records can become challenging without the proper tools. Using specialized crypto tax software can streamline the record-keeping process by tracking transactions across multiple wallets and exchanges, calculating gains and losses, and even generating tax forms. For individuals participating in activities that involve regular income, such as mining or staking, organized records are crucial for accurately reporting income as well as any gains or losses when assets are eventually sold. These records also act as a safeguard in the event of an audit, highlighting the importance of thorough documentation in an investor's tax strategy. Charitable donations of crypto, a smart way to reduce taxable income. Donating cryptocurrency to charitable organizations can be an effective way for investors to reduce their taxable income. In the U.S., the Internal Revenue Service allows crypto donations to be deducted at their fair market value, provided they've been held for more than a year. This deduction can apply even if the asset has appreciated significantly, allowing investors to avoid capital gains taxes while claiming a charitable deduction for the asset's full market value. For example, if an investor bought $1,000 worth of Bitcoin and it appreciated to $5,000, donating it to a qualified charity would allow them to claim a $5,000 deduction while avoiding taxes on the $4,000 gain. Donations exceeding $5,000 require a qualified appraisal to substantiate the deduction. Many nonprofits now accept crypto donations, making it easier than ever for investors to contribute appreciated assets to charitable causes while enjoying the associated tax benefits. For investors who want to reduce tax liability and support meaningful causes, charitable donations are an increasingly attractive strategy. The impact of international tax regulations. Staying compliant across borders. International crypto investors face unique tax challenges as each country has its own rules and rates. For example, Italy recently proposed raising its crypto capital gains tax from 26% to 42%, reflecting Europe's shift towards stricter taxation. Investors with cross-border holdings must understand each jurisdiction's tax requirements to ensure compliance and avoid penalties. Double taxation can arise when operating in multiple countries, although some tax treaties mitigate this issue. Since treaty specifics vary, consulting tax professionals' experience in cross-border tax laws is essential. As international regulations evolve, ongoing compliance remains a top priority for global crypto investors. Preparing for upcoming tax changes. The crypto tax landscape is likely to continue evolving as governments seek to regulate and monitor the growing market. One of the potential changes being discussed is the application of the wash sale rule to crypto, which would prevent investors from claiming a tax deduction on a loss if they repurchased the same asset within 30 days. If implemented, this change would impact tax loss harvesting, a popular strategy for crypto investors. Additionally, tax authorities are examining ways to regulate decentralized finance, non-fungible tokens, and other emerging areas in the crypto space. Investors should prepare for potential regulatory shifts by staying informed and consulting with tax professionals to adapt their strategies as laws evolve. Being proactive about changes can help investors optimize their portfolios, avoid surprises, and maximize tax efficiency in the years to come. Thanks for diving into crypto tax strategies with us. If you found this video helpful, hit that like button and don't forget to subscribe for more tips on mastering your investments. Let's keep growing that crypto knowledge together.